4.4%, the big figure which everyone was keeping a close eye on, gross domestic product or GDP, which indicates how our economy is doing. The first quarter GDP data has actually been below the general consensus of 4.7 or 4.6. On a quarter-on-quarter basis, that's down from 4.8%, which essentially means that we were in January and March clocking a growth of 4.8%. We are down to 4.4%. If you look at year-on-year figure, from 5.4, we are down to 4.4. This is a little worse off than what the estimates on the streets from economists had been. We're going to get you a detailed breakup. Where has the hit been bigger than expected? Agriculture was expected to be the silver lining. Manufacturing was supposed to take a big plunge, but definitely it's a big growth plunge coming in right after the Prime Minister stood up in Rajya Sabha to calm nerves around the economy, but it doesn't seem so. I'm going to get my first quick reaction from economists. We've got Mr. Shankar on the line with us. Mr. Jay Shankar, 4.4%. So the range was 4.3 to 4.6. One was hoping we would get 4.6. Mr. Jay Shankar, can you hear me?
This is broadly yeah, I can hear you. This is broadly very much in line with the street expectation. The fact remains that we have seen a significant slowdown in the economy, especially in the services sector, which follows as a lag to industrial slowdown. And industrial growth is almost likely to be flat. I haven't seen the detailed numbers, but I would be surprised if the number would be more than 1.5%. I mean, for the whole fiscal, I think it's a very sorrow state of affairs, if you like, and to begin the year with a quarter number of 4.4 is definitely disappointing.
Right.
But I think this is very much priced in by the market participants and all the investor community.
All right. Let me also get Paranjoy Guha's reaction. We'll just get that reaction. Okay, manufacturing. Now, we haven't got the details yet, but it seems that the manufacturing sector should be the biggest culprit here. Fully discounted 4.4% is what Mr. Jay Shankar is saying. Mr. Jay Shankar, in the morning, we had the Prime Minister saying there is no loss of confidence in the economy. Do you believe that? If you look at the GDP figures and the decline that you see both on a quarter-on-quarter basis, year-on-year basis, do you really believe that as of now corporate India is in any mood to invest?
No, I think, Manisha, if you look at some of the macro numbers, be it the outward FDI, if you like, which is basically the amount of capital which is going out of the country in terms of investment, and the kind of outflows that we have seen, that clearly belies the fact which the Prime Minister was telling, or rather trying to highlight, that the investors still have confidence in the economy. I have serious doubt, because no investor, if you talk to, be it domestic or international, is in any way in a mood to think of investing in India.
All right.
And for reasons better understood.
Fair enough. Let me get Mr. Keki Mistry, Vice Chairman and CEO HDFC, his reaction. Mr. Mistry, was 4.4% a figure that the industry has well discounted, or is it worse off? Because I was thinking 4.6 or 4.7 is the estimate.
Yeah, I would have thought 4.5 to 4.7 or 4.5, 4.8 was the average that people were looking at. In that context, 4.4 may be obviously a little low. But we need to understand what happened and what item, where the reduction was the maximum. Obviously, it will be manufacturing, because manufacturing, we know there is a slowdown. We know that the investment cycle has been significantly impacted over the last 2 or 3 years. But one has to also see what's happened on the agriculture front, because with good monsoons, good rains, hopefully the agricultural front, things should have looked better. The other thing we need to understand is what impact the rupee depreciation has had on this number of 4.4%, because this is for the quarter ended June, and then June the rupee was much better than where it is now. So going forward, the impact that we could see in this present quarter could probably be even worse. But it's too premature to talk of these things unless and until we have a breakdown on what kind of numbers has come on the different sectors.
All right. Mr. Mistry, we do have the manufacturing number and that's not looking pretty at all, sir. It's actually a negative 1.2%. Little scary, very scary.
I would think that is what has pulled everything down, and frankly, I would not be entirely or overly surprised by that number, because we know that for the last 2 years or so, the investment cycle has been slowing down. So that ultimately has to get reflected in manufacturing numbers.
Agriculture, sir, has seen a little bit of an improvement at a little above 2%, 2.7 versus 1.4 Q on Q. That was the estimate looking at the good winter crop. The PM said that Q2 onwards of the current fiscal year, you should see the economy or GDP numbers beginning to look a little better. Would that all then hinge on the monsoon and better agricultural productivity? Because other sectors are not going to be quick in recovering.
I would think, yes, it will depend a lot on the rural sector, because whilst the urban sector has been slow, the rural sector would do well because of the various programs which, one, the government has had, and two, the good monsoons that we fortunately had in the current year. I would only look at the impact of the currency in the second, because that can have a fairly material impact in terms of reducing whatever benefit we will get because of the good monsoon.
When you say you would watch out for the currency impact, just give it to us in layman terms. What are you expecting? Exports to jump up substantially? Because the data that we've got on the trade also numbers doesn't look promising, at least for the quarter gone by.
No, I would look at it like this, that the IT sector has done well, has done fairly well, because of not just because of the rupee impact may have been lesser, but largely because of the improvement in the sentiment, improvement in the economy in the Western world. The demand for IT services has clearly been growing, and that is reflected, if you see, in stock prices of the IT companies also. But the weakness in the GDP numbers in the second quarter will come because of the depreciation of the rupee, which will have its impact in terms of, cost of production going higher and so on and so forth.
Right, fair enough. So that could actually impact negatively. Mr. Keki Mistry, thank you very much for your quick reactions on that first quarter GDP number. I have with me Paranjoy Guha on the line as well. Paranjoy, 4.4% is the GDP number, slightly lower than street estimates of 4.6. You also have manufacturing slipping into the negative at 1.2%, minus 1.2%. Agri growth, yes, has gone up as expected, but not as much as one would have hoped for. We were hoping for a number of 3% plus. Sum up your first reaction. I mean, is this pretty much like, okay, we just got to deal with it, this was expected, or is it worse than what we expected?
I'm not in the least surprised with these numbers. In fact, the numbers could have been even worse. And I won't be surprised if the second quarter numbers are as weak, perhaps weaker. I very honestly, the Prime Minister is entitled to his optimism. He can say that, second quarter he hopes for a revival. He can hope that GDP growth will be 5.5% for the full financial year. But very honestly, I think realistically speaking, this is not going to happen. I mean, we are today caught in a vicious cycle, and it's a kind of like a chakravayu where one problem is feeding on another. And let me summarize what I want to say. Suppose you have a high current account deficit. Why do you have a high current account deficit? It's because your trade deficit is very high. Why do you have such a high trade deficit? Your exports are not growing despite the devaluation in the rupee, because your markets for your traditional exports, whether it be garments, textiles, gems and jewelry, diamonds, leather products, processed foods, are all, they're stagnant or not doing well in developed markets, especially Western Europe. Now, with exports not growing at the rate expected despite the devaluation, imports continue to grow. Now, take the biggest item of import. Almost 40% of our total import bill is crude oil. You have the problem in Syria. You have a huge problem on the oil front. Now, what do you say? Good politics, good economics. You've chosen this time to cut subsidies and align domestic energy prices with international energy prices. That means you're allowing diesel prices to creep up. And what does that mean? Your inflation goes up. Now you're telling people don't import gold, don't buy gold. Belatedly, rather late in the day, you've increased customs duties, you put certain barriers on imports of gold. Why are people investing in gold? People are investing in gold because of inflation. Now, people are gold is rightly, wrongly perceived to be as a hedge against inflation. For the last 4.5 years and longer, you've had food inflation in double digits. You've had food inflation driving generalized inflation.
Okay,
you've had the
hold
real
your thought
incomes
on
of the
gold.
poor.
Hold your thought on gold. Okay, carry on.
One point. I'm saying look at the vicious cycle. High current account deficit, high trade deficit, high imports in rupee terms of oil, high imports of gold. Why are you importing gold? Because you have inflation. What does your high imports of oil mean? Diesel prices. You have more inflation, low growth, and you're back in that vicious cycle.